What's up, guys? Welcome back to another episode, Stock Talk with David. Obviously, this week we're going live, so we'll give it a couple minutes to figure out, see if anyone else is going to jump in. What's up, guys? So yeah, going back, one of the first things I want to talk about today is actually oil. And so if we look at oil, we'll see that it's up just a bit from the close, actually. So my whole point with looking at this is we see that it hit 100. We're looking at a weekly chart. I mean, we could go a little bit deeper, maybe an hour. We can see it did gap up and it hit 100. And really what it suggests to me, and like what we said last week, is that this stuff is mostly priced in, you know. Because we got the solid news that Russia did invade, and then we look at the oil, and oil actually fell for a couple of days, right? It pulled back, consolidated, popped up off of, just low volume, weekend trading, things like that. So that's kind of what I think is happening. Like, a lot of this is actually priced in. And so some people were asking me, they're like, how do I trade oil? How do I get into commodities? What do I do? How do I make money? And the thing about it is the smart money's already gone. So what you have now is you just have people that are literally standing in the way of a freight train coming to pick up pennies off of the railroad track. Like, it's so far gone at this point. The move's already done. If you weren't in it, you should have been in defense stocks. You should have been in weapons. You should have been in energy, commodities, things like that 4 weeks ago before any of this stuff happened. So at this point, it's not anymore trying to trade these U.S. oil, or try to trade any of the commodities, the XLE, the XLF, none of that stuff. We're trying to find the next big thing, right? So that's literally the whole point of what we do. That's why we say we strive to trade with the smart money, right? But we'll go do a quick update, just some of the weekend stuff. Obviously, a lot of nuclear deterrence forces, high alert, just noise. Let's see, anything good? Markets are kind of up, down, in between. So not really moving, right? Everything's just mixed. And what that means is that we're just waiting to figure out what's going to happen next. At this point, it does look like, I just saw a report, it does look like the Fed will be figuring out how to assist the world economy, given that some of the SWIFT payments, it's really complex and technical. But now that Russia's out of the financial loop, how do we, keep money flowing? How do we make the economies, the worldwide economy, how do we make it work? And it's going to be through pumping excess U.S. dollars, right? So does that mean they completely stop the rate hike? Probably not. Do they limit it by, a few basis points? Probably. But that's actually going to be really, really bullish for stocks, right? See if I can find the futures ticker for TradingView. Let's see, futures. There we go. That's fine, close enough. So yeah, small gap down. You guys can see that. You know, a few percentage points. Really, again, low volume is going to do that. Okay, weekend trading is going to do that. Not having any clarity on the situation is going to do that, right? So that's all I wanted to get through with some of the weekend stuff. The last thing I want to touch on, we went over this last week. If we look at it again, this is the ISM report. This literally tells us what's happening. This is a leading indicator, so this indicator that we look at, it has about a 3-month head start on the actual markets, which is cool, right? We can look at this and we can see what parts of the market, what sectors are going to do better than the other ones. This is the ISM. So anything over 50 is really good. Anything over 50 means we're growing. Anything below 50, you know, this number's kind of pulled back, consolidated for a while too. But you can see we're looking at, I think, services right now. But if we look at services, we'll see that, you know, it fell back 2.4%. It was 62 in December. Now it's 59. It's still growing. It's, you know, it's making positive moves. It's just starting to take a little bit longer, right? It's slowing down, which kind of makes sense, you know, given we look at the market last year, fell down, snapped back up really fast. I mean, everything kind of did the same thing, right? The one thing I found interesting is we look in construction, costs have escalated to what we believe are unsustainable levels. Labor non-existent, cutting staffing, taking on fewer projects, outsourcing where possible, and not optimistic at this time, right? So what does that speak? This is really just going back to the supply chain, right? They can't get in, the materials cost a ton. If they can get it, it's very expensive. Think about all the oil they have to use for construction projects, right? And I assume this is kind of more, I don't want to say public sector, but more of the construction, like road work, right? We're looking at the construction of larger buildings. I don't think this is necessarily home building, right? But we look at available labor is non-existent. That makes sense. Having to cut staffing because everything's so expensive anyway. And they're just not optimistic. So we could always find, if we're looking for shorts, we could look for that, right? That's fine. The second other thing on here that works in accordance with that is actually the new orders. If we look at new orders, they're growing, but at a slower pace. So people are kind of peeling back, you know, the orders that, you know, that they're placing. Employment's down, supplier deliveries, inventories up a little bit, prices, backlogs. So yeah, I mean, you can look at it, it's mixed. Nothing stands out. Nothing is just absolutely wow, like this is great. Cool. Okay, so that's what I got there. And let's see, we got a couple guys on. What stocks are you guys looking at this week? We'll talk about Meta and Alibaba in a second, but what are you guys looking at? All right, we'll go to Meta then. So if we talk about Meta, if you've seen my videos, you know that I'm not super bullish on the stock, but a lot of guys in the group actually have it. Like we got this at 30 something cents. We ran it all the way up to the 11 or $12 that it went to. And now they're just consolidating, right? They've pulled back. You know, they're a small cap company, so they're going to be exposed to interest rate risk. They're going to be exposed to things like that. We can see, I'm going to go to a better chart. I like to look at the weeklies. This chart's actually pretty ugly because it had this big spike, but we'll make it work. Cool. So yeah, so you guys can see that it, you know, it's hovering around this $152 range, just back and forth, back and forth, back and forth. What's going to drive this thing? Confirmed revenues, right? What else is going to drive it? A lot of buying. It's going to be getting any type of debt that they have off of the books. It's going to be getting contracts in place. It's going to be catching up to the, you know, the revenues catching the market cap. That's what it's going to be. So I'm actually, you know, am I bullish on it? Absolutely not. Do I think that it could definitely, though, even though it's $1.80 right now, does it have the potential to be $4 by the end of the year? Maybe, but they have to get their, you know, they have to confirm their revenues, right? We don't really know. We see all these partnerships. We see them putting the cool paint on the BMWs that can change colors at the Consumer Electronics Show, right? We see all that stuff, but we don't have any like confirmation like bam, this, we're making this amount of money from these projects, right? And if they're partnered with all these companies, why are they only making a couple $100,000, a quarter? Like something doesn't make sense. And so hopefully we get a 10K, we can get a little more, depth on the company for the average investor. Yeah, maybe we'll see some volume and stuff. That's my thoughts on that. And then we can also talk about the dividend as well. So let's see, MMTLP. So this is the preferred share for MetaMaterials. If you guys aren't sure what that is, when they literally what happened is Meta and Torch, they merged, they got together, and they decided that if there's anything left over from the sale of our oil projects, this is going to be Torchlight, that they're going to spin it off into its own entity, its own share, its own preferred dividend, and once we sell it, this is your stock that you're going to hold in your account, and then when we actually get a number on how much money we're making from the sale, we'll give you all the money that it's worth, right? So that's a preferred share, it's a placeholder, okay? Now, what we're looking for with this, and I think is interesting, that it's almost chasing the same price as Meta. And I feel like the reason there is because no one has a really solid estimate about how much this thing could even be worth, right? There's no, we're not really sure on the pricing. We're not sure how we're going to get any, the actual breakdown of it. So it's going to be some type of function of how many shares they have times how much, or divided by how much oil they can get, right? It'll be some type of function like that. Now, luckily for the people that hold this, as we just saw, oil is absolutely crazy. It's off the charts. This is a good thing for this particular preferred share, for this situation that we're talking about, right? This is awesome. Will this go higher? I don't know. I think with the Iran deal, it'll be somewhere down here into like the 80 range, and then it might pull back up in a couple of months, right? But that's just the idea, is that the higher this goes, the better the dividend looks for MetaMaterials. Look at a week in review. So yeah, I mean, market definitely tanked on the 24th. We can see, a lot of volatility, tanked, and then just an absolute awesome comeback, from that early morning session, I think Thursday, all the way up to Friday. So that was nice to see. And then this leads me to my next big point, is actually Alibaba. So if you've been with the channel for a while, you know that Alibaba is an absolutely undervalued stock. Like, let me just show you guys how cool this is. Let's see where we go. So I'm going to show you guys the stock price, and I'm also going to show where the earnings per share are. And this is so interesting to me. And once we kind of break down to some of the workings of the company, I think it'll make more sense. So I'm just going to make this a 5-year chart, and I'm just going to change the frequency. You can see how the EPS, basically how much the company is making, how that changes every quarter compared to the stock price. So check this out. Okay, we go to 2017. We're trading at about $100 a share, 108, literally the same thing, okay? And then on our green line, and this is actually going to be the EPS. I'm going to change EPS again to, should be able to change it to US dollars. USD. There we go. Okay, perfect. So you guys see this right here, that a couple years ago, 2017, we could have bought this at $108 and it was trading at $1.11 a share, okay? and we come over here, we can literally get it for the same price as 2017, but the EPS has gone up over 100% in that time frame, right? So what does that mean? It means the stock itself is extremely undervalued. Like, how cool is that? The stock is extremely undervalued. This is the thing. What's driving this down is the geopolitical risk from China, right? Everyone with China, they're scared to death of them. But the thing about it is it's a symbiotic relationship. We need China. China needs us. Okay. If you don't have them together, it's just not going to work, right? We depend on them. They depend on us. Whether it's currency, whether it's goods, whether it's services, the entire world depends on that relationship. And we've been worried about, delisting. We've been worried about the tariffs. We've been just anything and everything, the China crackdowns. But when you think about it, China can't afford to crack down any harder on any company, especially Alibaba, because Alibaba is their closest thing to competing with Western capitalism that they can do, right? Alibaba is a huge company, over 1 billion users, total users to the company. That's pretty big, right? It's their closest thing to Amazon, okay? And they actually do more than Amazon. So what we're going to find here is that all this talk, all this noise, everyone being we're scared, all the way down here to 2017, only a matter of time until we absolutely bounce, we cross over here. And if we were to do the math right on it, it's pretty easy. I think most estimates now have it about 250, 260 on the really conservative side. And you can get it now for literally $108 a share, right? So there's more to it than that. If you want to know more, be sure to check out the group. We're going to look at the earnings call, the earnings release that they just did. This is going to be for December. This came out last Thursday, I believe. So actually not too long ago. 10% increase on revenue. This was grown by the Chinese commerce segment. The cloud segment grew 20% year over year, which is absolutely insane when you think about the pure and sheer size of the cloud anyway from Alibaba. That's a lot. Income from operating decreased a bit. This had to do a lot with the expenditures, the CapEx that they were putting into the company. If you call it CapEx for tech, they were spending a lot, right? And that makes sense. Annual active consumers reached 1.28 billion for the 12 months ended basically just last year. That's a lot. That's 1.28 billion people. I think right now there's like 7.5 billion in the world. Maybe guys, that is a lot. Why is nobody looking at this? 1.28 billion users monetized just in Asia, primarily China. Look at that. That is insane. That is absolutely insane. They've got maybe 25% coming from overseas outside of China. That is wow. That is so cool. Okay. Adjusted EBITDA, this is EBITDA decreased 27%. Yeah, and this had to do a lot with their growth too. So if they're investing more in growth, they're gonna keep less money, and they're gonna be taxed on a little bit less. So it, will lead to a bit of a decrease on the number. Net income. So we do see this had again to do with the investing. This is cool. Earnings per share. This is a very conservative estimate because it's diluted per ADS. These are the American shares. $1.18 and diluted earning per share for the US, not counting ADS. This is really what we want to look at. This is what we're trading, or the ADS is 1.18. Okay. Decreased 23% year over year. Okay, so that's pretty consistent with what we just read. Again, the cash flow. So a lot of investing was happening. We come down here. They had 882 annual active consumers for Chinese commerce. I want to see what they did for the cloud. Come over here to cloud, increased 20% year over year growth from financial and telecommunication industries. That's fun. Partially offset by continued impact of a top cloud customer's decision to stop using our services. So this could be very much politically related, to everything that's happening, all the drama with China anyway. Let's see. Share repurchases. Okay, this will be fun. I haven't looked at this just yet, so I wanted to go over it with you guys. During the quarter, we repurchased approximately 10 million of our ADSs, these are the U.S. shares, for approximately 1.4 billion under our share repurchase program. For the 9 months, so the quarter up, the 3 quarters up, they purchased approximately 7.7 billion, representing 51% of their $15 billion share repurchase program. Our current share purchase reprogram will expire by the end of December 2022, and I guarantee you, when they went out in the market, the knee-jerk reaction that they had to earnings, I guarantee you they went out and they bought some more. And that would actually make sense, because if this thing came out looking flat as it is here, let's do earnings one day. Yeah, I mean, they closed right where they opened, right? So that makes a lot of sense. So they definitely went out, they bought some more shares. Good for them. That actually helps the shareholders a lot. It's called returning value back to shareholders. We'll do more on this, like a detailed video. It can get really deep with some of these things, some of the analysis. But I think what's important is to understand the catalyst and the drivers. Main catalyst right now is that China is just opening up the liquidity. So if you think about how much time we spent, or how much money we spent in stimulus for 2020 to 2021, and even kind of right now with some of the continued bond buying, yeah, it makes a lot of sense. So China's doing the same thing. They stopped too soon, they got into trouble, and now they're literally taking all steam ahead to get this thing knocked out, to jump more money to the economy, and so you're going to see just almost everything Chinese go up. That's going to be a lot of fun. Let's see. I don't think we have any questions in here. Let's see. I'm not sure if our usual people are on. All right, so we'll look at the week ahead, and then if that's it, then we'll call it a day on that. So week ahead, invasion. Let's see, Brent surges to above 104, early trading. So this happened, looks like it went up and it pulled back. This is saying now we're at 102. So maybe we missed that in the 5 minutes that we were here. It makes sense though, like the knee-jerk reaction, the oil sold off, so it's like, you know, they definitely, traders were not expecting it. And I totally didn't think that they would, but I'm not surprised, right? Like I'm not surprised that the invasion, happened. I didn't think it was, but I'm not surprised. And I think the market actually reflects that same view. You know, like I can beat this all over, but US 500, yeah, I mean, this is basically the news of what happened right here. And the idea here is that if this is going on, that we're going to get more money in the economy, so that will be great, at least for stocks. In the long term, probably not good. Short term, great. US Treasury yield dropped as much as 8 basis points to 1.9 in early Asian trading hours. So if you were in financials, your stocks might be down marginally tomorrow, because a lot of times financial stocks, they trade hand in hand with the interest rate. The higher the interest rate, the more the bank, the financial company can charge its consumers, its people, its customers. Do we have any other news? New Zealand business, natural gas. Very last thing will actually be this, because this is going to set the tone for the next, at least the next 3 months. Let's see. So this is the University of Michigan Consumer Sentiment Survey. It just measures, you know, how optimistic are consumers, and they're not really that optimistic. Year over year, this is down 18% January to February, we're down 6.5%, which is significant. We can see year over year at 76, to 62.8. That's a lot. People are really pessimistic, but one thing we know is that when people are pessimistic, we always buy more, right? We look for the value, we look for the companies that are just going down with the market, but we look at things and the fundamentals that just nothing changed, right? There's nothing changing with the fundamentals of these companies. So why wouldn't you go back and try to pick them up at a discount, right? That's the idea. Wall Street's the only place where they have a sale, no one shows up. So it's still at the lowest level that it's been at in the past decade. So this is definitely the worst 10 years, that's what that's saying. Loss was due entirely to a 12.9% decline among households with incomes of $100,000 or more. To me, this sounds like people that own assets. People that own assets typically make over six figures. Generally speaking, obviously that's not the case all the time. But if they're worried about their, if their sentiment if their sentiment for consumption is down, it's probably because their assets went down. And because their assets went down, they're not going to spend as much, right? They're more worried. They're trying to save. It's behavioral finance. It's not really my realm, but that's the idea, right? And it literally resulted from inflationary declines in personal finances, near universal awareness of rising interest rates, people getting scared, people selling, right? All right. I thought that was going to show you guys, but I don't think it really matters too much. If you guys are new, we just went over the metamaterials, went over metamaterial preferred shares. We also talked about oil, talked about Alibaba, so a lot of good things that we were mentioning. Let's see, we can wrap it up soon, but CNN, let's see, CNN, fear and greed. $31, so they are at pretty nervous. They're fearful. The previous close was 25. Now we're at 31. So this is a great time to start finding those companies, the companies you have on your watch list, the ones that we're talking about. Put the small trade on. Don't be scared of it. Again, I don't know anyone's financial situation, so this isn't financial advice. This isn't anything like that. Making recommendations. Talk to your financial advisor. Find the plan for you. I don't deal with individual investors, but this is what I'm saying is that when everyone's fearful, that is the time to show up and keep buying. And this is obvious because if I look at S&P 500 for we'll do weekly because it'll be a little bit easier for everyone to see. This is COVID right here. We literally fell down from 340 to 220, and we ended 2021 at 480. So that is a significant increase, nearly a double, right? Maybe 80, 90, 100%. That's awesome, right? That's the power, though, of realizing that the fundamentals of these businesses didn't change. Obviously, there's a lot going on underneath the hood. Will it be as easy? Will the money be as easy in 2022 as it was in the past 2 years? Absolutely not. You have to be more disciplined. You have to be a better trader. You have to understand more things. Do your research. Read your 10Ks, right? And then when you understand all that, pull the trigger. Do your buying. Find the great companies that generate cash flow, right? I think Eric's in here, and he's an accountant. He'll tell you how extremely important cash flow is, So you find the companies that have cash flow and they're just growing, and that's it, guys. Like, that's literally all it takes. Thank you, Eric. I appreciate the nice comment. All right, guys, so that's about it. I don't think there's any more questions or anything for the live stream. So thanks for watching. If you're watching this on replay, be sure to check out the Discord group. We talk a lot about these stocks on the daily. There's always different news coming out, different opinions, different ideas. The thesis generally holds true, but we like looking at them on a weekly basis, just reviewing what's changed, what's not, and adding to them when they're down, because it's made all the difference. It makes everyone a ton of money when you add smartly when they're down. I think that's it, guys. Have a great weekend. If you have questions, be sure to shoot the questions right to me, and we'll learn more together. We'll do the best. Send your recommendations or your ideas. If you want a video on it, or you want a quick little review, I'm definitely happy to do it. So thanks, guys. Have a great week.